$200,000 at age 50, $1 million at age 65. That's a 5 times multiplier in 15 years. And I'm going to show you exactly how the math works, down to the specific tax levers, the fee numbers, the sequence traps, and the healthcare bill that will blindside you if you retire one day before 65. Most people think this is a savings problem. It's not. It's an execution problem. And there are 4 very specific places where the execution breaks. Here's the thing about 50. The conventional story is that you're too late. The compounding clock is almost out of time, and you should basically lower your expectations and just pray Social Security doesn't collapse. That story is wrong. And I can prove it with a spreadsheet that takes about 30 seconds to run. The average yearly return of the S&P 500 is 10.3% over the last 30 years. As of 2026, assuming dividend reinvestment, $200,000 at 10% annual return for 15 years becomes $835,000. Without touching it once, without adding a single dollar, just compounding, doing what compounding does. Add the catch-up contributions that the tax code specifically hands you at age 50 contributions most people don't even know exist. And you clear $1 million with room to spare. But nobody talks about the 3 things that will stop you from getting there. And one of them is hiding in your 401k statement right now. In a few minutes, I'm going to show you the only number in retirement planning that actually determines whether your money survives the first decade of withdrawals. Most people planning for 65 have never heard of it. But first, here's why the math most people use to plan their retirement is actually built on a fiction. Let's talk about the central metaphor I'm going to keep coming back to throughout this video. Imagine an ultramarathon runner at mile 40 of a 60-mile race. They have everything they need to finish. The fitness is in their body. The training happened. What determines whether they cross the finish line and how they cross it is what they do in those last 20 miles. The nutrition, the pacing, the decisions about when to push and when to protect. Blow the strategy in the final miles, and all that training was for nothing. Get it right, and you run the best race of your life. That's exactly what 50 to 65 looks like financially. The first 30 years of your career built the base. You have $200,000. The finish line is $1 million. And the question is not whether you have enough time. The question is whether you know where the throttle is and whether you know which mistakes will blow the race before you hit 65. Let's run the first mile. Most people think the problem with their retirement savings is the amount. They don't have enough. They started too late. They should have saved more in their 30s. That's what they think the problem is. But here's the reversal. The amount is not the problem. The behavior is the problem. And the data is almost embarrassing. While the long-term average return of the US stock market is roughly 10% per year based on the S&P 500 index, most people's average return is less than half of that. A JP Morgan study found that investors averaged a 2.9% annual return, while bond and stock returns were much higher over the same time frame. 2.9%. Let that land for a second. The market returned 10% over long historical stretches. The average investor captured 2.9%. That is not a market failure. That is a behavior failure. People buy high because they feel confident when prices are rising. They sell low because they panic when prices are falling. They move in and out, trying to time things, trying to be clever. And in the process, they give away 7 full percentage points of annual returns. Here's what that 7-point gap costs you in concrete dollars. $200,000 at 2.9% for 15 years becomes $312,000. $200,000 at 10% for 15 years becomes $835,000. The difference between those two outcomes is $523,000. Not because one person was lucky and one person wasn't. Because one person understood how their own brain was going to betray them and built a system that removed the brain from the equation. Most investors buy and sell too much without knowing what they are doing. They buy and sell at the wrong time, but think they're doing the smart thing. If you want market average returns, buy and hold stock index ETFs. That's it. That's the first lever. Boring, unsexy, and worth $523,000 over 15 years. But there's a second piece to this behavior problem, and it's more subtle. It's not just timing the market, it's the funds you're in. Because the financial services industry built an entire ecosystem around selling you products that charge more and perform less. And the data on this is as clean as any data in finance. Over the 15-year period ending December 2024, not a single US equity fund category had a majority of active managers outperforming their benchmarks. 0 categories out of 22. That result holds after accounting for funds that merged or liquidated. 0 out of 22. And in 2025 specifically, 79% of active large cap US equity funds underperformed the S&P 500, the 4th worst year for active large cap managers over the 25-year history of the SPIVA scorecards. Think about what that means for you. If you are in actively managed funds right now, which most 401k plan menus heavily favor, there is an almost 9 in 10 chance that a simple index fund would have beaten your fund over the last 15 years, after fees, after all the research, after all the fund manager's expertise. The probability of picking a winning active fund over 15 years is roughly 1 in 10. Those are lottery odds. You are not supposed to play the lottery with your retirement. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. This is the behavior problem solved at the structural level. Get out of active funds, get into low-cost index funds, and stop touching it. That's the track to run on. Now let's talk about the throttle. Stay with me, because this next part changes everything. Because turning 50 doesn't just mean you're running out of time. It means the tax code just handed you a set of tools that weren't available to you at 35, and almost nobody uses them correctly. Here's what happens at 50. The IRS says, you're close enough to retirement that we're gonna let you put more money into tax advantage accounts than everyone else. These are called catch-up contributions. And in 2026 specifically, the numbers are substantial. Your 401k allows an extra $8,000 per year in catch-up contributions in 2026, bringing your total possible contribution to $32,500. Your IRA catch-up limit has been adjusted for inflation to an extra $1,100, allowing a total IRA contribution of $8,600. So starting at 50, you can funnel up to $32,500 into your 401k annually, completely tax deferred. That's money that doesn't get taxed this year. It grows without taxes. And if you're smart about it, it potentially never gets taxed the way you might expect. Let me show you the math of adding that catch-up contribution to the $200,000 scenario. If you add just $8,000 per year in catch-up contributions on top of the $200,000 that's already invested, and you earn 10% annually for 15 years, those annual contributions alone grow to $254,000. Add that to the $835,000 from your base, and you're sitting at $1,089,000 at 65. You cleared $1 million without finding a new career, without learning to trade options, and without praying for a miracle. You just use the tools, the tax code specifically designed for your age bracket. But there's a second lever in this era that's even more powerful, and almost nobody in their 50s uses it. It's the Roth conversion ladder. And here's why it matters. Most people at 50 have the bulk of their retirement savings in traditional pre-tax accounts, their 401k, their traditional IRA. Every dollar in those accounts will be taxed as ordinary income when they withdraw it. If you retire at 65 with $800,000 in a traditional IRA and start pulling out $60,000 a year, you're paying income tax on every dollar. At current rates, that might cost you $12,000 to $14,000 a year in federal taxes alone. Over 20 years of retirement, that's potentially $250,000 or more in taxes on money you already earned. A Roth conversion ladder lets you convert IRA funds in steps, manage taxes, and create long-term access to tax-free retirement income. A Roth conversion ladder is a strategy that gradually moves money from a traditional IRA into a Roth IRA over the course of several years. Instead of converting your full balance at once, you convert smaller amounts annually. Each conversion becomes a new rung on the ladder, and after 5 years, the converted amount can generally be withdrawn tax-free and penalty-free if you follow the IRS rules. Here's how this plays out. at 50 specifically, let's say you have $200,000 in a traditional IRA and you're earning $65,000 a year in salary. Your standard deduction and personal exemptions bring your taxable income down. In some years, especially if you have deductible business expenses or other offsets, you might be in the 12 or 22% federal bracket. Every dollar you convert to a Roth at those rates is a dollar that will never be taxed again. Not when it grows, not when you pull it out in retirement, not when you leave it to your kids. Roth IRAs do not require minimum distributions during the account holder's lifetime. A notable difference from traditional IRAs and 401ks, where required minimum distributions start at age 73. This feature makes Roth IRAs particularly appealing for those who wish to preserve their retirement savings for later in life or pass them on to heirs. The window between 50 and 65 is the single best conversion window most people will ever have. Your income may start to plateau or even decline if you shift to part-time work. Required minimum distributions haven't kicked in yet. You have a 15-year runway to move money out of a tax-deferred account and into a tax-free one, paying a relatively low rate today rather than an unknown higher rate later. That's two levers. Behavior plus structure equals the freight train picking up speed. Now, I want to tell you about someone I've been thinking about while writing this video. Let's call him Robert. Robert is 52. He spent 22 years in the same corporate job, maxed out his 401k consistently, put everything in the target date fund his HR department recommended. On paper, Robert did everything right. He has $230,000 saved. He's proud of it. He's planning to retire at 65. What Robert doesn't know yet, and won't find out for another 3 chapters of his story, is that 3 specific things have been quietly working against him the entire time. I'll come back to Robert. Here's where it gets really interesting, and where the video title's math starts to make a lot more sense. Because even if you fix the behavior problem, and even if you use the catch-up contributions, there's a third force actively working against you that most retirement calculators don't show you. And it's not a market risk. It's a structural tax on your wealth that's hiding in plain sight. Fees. Look, I've been running my own business for over a decade, surrounded by accountants and fiscal lawyers. I have multiple hundreds of thousands of dollars invested personally. And even with that background, the true cost of fee drag took me a while to fully internalize, because the numbers are presented in percentages, not in dollars. And percentages are psychologically invisible. Let's make it visible. $200,000 at 10% per year for 15 years becomes $835,000. The same $200,000 at 9% per year, just 1% less, the kind of fee you'd pay a perfectly reasonable advisor grows to only $728,000. That 1 percentage point of fees costs you $107,000 over 15 years. That's not a rounding error. That's more than half of what you started with. Fee drag compounds exponentially, not linearly. A 0.5% fee difference sounds trivial annually, but costs approximately $59,100 over 20 years and $165,800 over 30 years on a $100,000 initial investment. The gap nearly triples between year 20 and year 30 because the compounding engine has a larger eroding base in later years. The cost of a 1% expense ratio versus 0.1% represents a 22.4% loss of ending wealth after 30 years. A 22.4% loss of ending wealth. From fees alone, not from bad decisions, not from a market crash, not from bad luck, from the fee structure you chose when you signed up. And here's what makes it worse. Annual fees compound through multiple chains of lost growth. In year 1, a 1% fee on a $100,000 portfolio costs $1,000. In year 15, it costs $2,750. By year 25, it exceeds $5,400. The percentage never changed, but the dollar cost tripled and then quintupled. Additionally, the $1,000 taken in year 1 would have grown for 29 more years at 7%. That single year's fee alone costs approximately $7,100 in lost compound returns by year. 30. That's what compounding in reverse looks like. Every dollar you pay in fees today is not a dollar. It's whatever that dollar would have become in 15 years. And the financial industry has been very careful to show you the fee as a percentage, never as a dollar figure projected forward. So let's add that to the picture. To get from $200,000 to $1 million at 65, you need to solve three things simultaneously: the behavior gap, the tax structure, and the fee drag. Get any one of these wrong, and the math breaks down. Get all three right, and you don't just reach 1 million, you likely clear it. There's a reason I named this channel Lazy Investor. It is not because I'm lazy. It's because I read the SEC filings, the SPIVA scorecards, the retirement research, and the consistent conclusion is that the lazy approach beats the active approach. Don't pick stocks. Don't pay a manager to pick stocks. Don't trade in and out trying to beat a market that has already priced in everything. Buy low-cost index funds, use the tax levers available to you, minimize fees, and leave it alone. That is not laziness. That is discipline. And the returns reflect it. Here's something I built for exactly this problem. The part that never makes it into a standard retirement calculator is the interaction between all these pieces: the sequence, the fees, the healthcare bill, the Social Security timing. You can know each piece individually and still get the whole picture wrong because the pieces interact in ways that aren't obvious. That's why I built a digital book called The Exit Code, an analysis of 50 years of retirement data distilled into a mathematical framework for understanding exactly when and how to exit the working world. I'm going to mention two things specifically from it that connect to what we're discussing today. First, the 4% trap. The conventional wisdom says you can withdraw 4% of your portfolio per year and never run out of money. The math behind that rule was built on specific market conditions that may or may not repeat. More importantly, it was designed for 30-year retirements. If you retire at 60 and live to 90, you're looking at a 30-year withdrawal window, and the 4% rule starts to look a lot shakier. The exit code walks through a dynamic withdrawal method that adjusts your withdrawal rate based on actual market conditions and portfolio performance each year, rather than locking in a fixed percentage that was calculated in a different era. Second, the 58% rule. Research on early and mid-career exits shows that a significant percentage of people who plan to retire at 65 are actually pushed out of the workforce. Before that, through layoffs, health issues, or company restructuring. The buffer strategy built into the exit code specifically addresses this forced exit scenario, so that if you're one of that large percentage who doesn't retire on their own timeline, your plan doesn't fall apart. You can get it for less than a single hour with a mediocre financial advisor through the link in the description. Not because it's a bargain price, because the information inside is harder to find in one place than anything else I know of at any price. Now, back to Robert. And back to the miles that nobody runs correctly. Robert, you remember, has $230,000 saved. He thinks he's on track, and he might be if not for what's coming in mile 13 of his last 15 miles. Let me tell you about sequence of returns risk, because this is the concept that determines more of your retirement outcome than almost anything else. And it only affects you during the withdrawal phase, not the accumulation phase, which means it's coming for you right around 65. Sequence of returns risk, also known as sequence risk, is the danger that poor investment returns early in retirement, combined with ongoing withdrawals, will significantly reduce a portfolio's value and limit its ability to recover. Even if the average annual return over time is favorable, early losses can compound the problem because withdrawals lock in those losses, leaving less capital to benefit from future gains. Here's the brutal version of this. Two retirees, both have $1 million, both take out $50,000 a year, both get the exact same average return over 20 years. The only difference is the order of the returns. Retiree 1 gets good years early and bad years late. Retiree 2 gets bad years early and good years late. During your working years, the order of returns doesn't matter much. A 20% loss followed by a 25% gain produces a similar result as the reverse, because you're not pulling money out. But once withdrawals begin, early losses compound in a way that later gains can't undo. Research by Wade Pfau estimates that approximately 77% of a portfolio's final retirement outcome can be explained by the returns of just the first 10 years. 77% of your retirement outcome determined in the first decade. Not by how smart you are, not by how hard you work, not by how well you planned, but by whether the market happened to go up or down in the years right after you stopped working. And this is where Robert's story turns. Robert retires at 62, forced out during a corporate restructuring. He doesn't want to retire yet, but he doesn't have a choice. His first year in retirement happens to be a down year. The market drops 17%. His portfolio falls from $230,000 to $191,000. He still needs to pay his bills, so he withdraws $45,000. Now he's at $146,000. The market needs to go up 35% just to get him back to where he started. And he's already pulled $45,000 out. That will never participate in the recovery. Sequence of returns risk concentrates in the first decade of retirement. And the reason is simple. That is when the portfolio is largest relative to the withdrawals. A 20% decline on a $1 million portfolio costs $200,000. The same 20% decline on a $400,000 portfolio costs only $80,000. In the first years of retirement, when the portfolio is largest, a market decline causes the most damage. The defense against this is not trying to predict market timing. It's structural. You build a cash buffer, 2 to 3 years of expenses in stable, liquid assets, so that when the market drops in year 1 or year 2 of retirement, you're not selling equities at the bottom. You're spending your cash. You let the equities recover. This is the bucketing strategy. And it's not exotic, but it requires you to think about this before you retire, not after the first down year starts. Now you're asking yourself, okay, even if I get to $1 million, how much can I actually spend? And here's the thing that almost every retirement video forgets to mention. The number you need at 65 is not $1 million in isolation. It's $1 million minus whatever the healthcare system is about to charge you for the 3 years before Medicare kicks in. Think about Robert again, leaving his job at 62. He's been on employer-sponsored healthcare his entire career. He paid maybe $200 to $400 a month in premiums. He walks out the door at 62, and suddenly he needs to find his own coverage for 3 years until Medicare starts at 65. Monthly premiums for 60-year-olds range from $1,401 to $1,675, depending on plan type and network size. Paying about $12,000 to $13,000 per year in premiums per person can consume a notable portion of annual retirement income, particularly for households relying on withdrawals from savings or investments. 3 years of private health insurance, pre-Medicare, at $12,000 to $13,000 per year in premiums alone, that's $36,000 to $39,000 just in premiums. Before a single deductible, a single copay, a single prescription. A 2026 report by EBRI found that some couples may need up to $469,000 in savings to cover their healthcare expenses in retirement. This is the invisible bill. And it's why the math that only accounts for investment returns is incomplete. You're not just growing a portfolio to withdraw from. You're growing a portfolio to pay your real expenses, which include one of the most expensive and fastest growing line items in American household budgets. Here's the dark comedy version. Financial advisor says, great news, you have $900,000 at 62. You can retire. You retire. 3 years later, your portfolio is at $840,000, not because of the market, but because you wrote a check for $60,000 to health insurance companies. The market is up, but you're behind. Robert didn't plan for this, did you? Now you might be thinking, okay, the catch-up contributions and the Roth ladder solve the accumulation problem. The bucketing strategy solves the sequence risk problem. Healthcare is budgeted. So what's the fourth thing? What's the kicker? Social Security timing. This is the decision that most people make wrong, and the math on getting it wrong is significant and permanent. Claiming Social Security at 62 reduces your monthly benefit by as much as 30% compared to your full retirement age. That reduction is not temporary, it is permanent. For the rest of your life, you receive a smaller check. On the other side, waiting beyond full retirement age increases your benefit by about 8% per year until age 70. Delaying until age 70 can increase your monthly Social Security payments by up to 24% compared to claiming at full retirement age. So the spectrum looks like this. Claim at 62, 70% of your full benefit forever. Claim at 67, your full retirement age. If you were born in 1960 or later, 100%. Claim at 70, 124%. The difference between claiming at 62 and claiming at 70 is a 54 percentage point swing in your monthly check for the rest of your life. If you live into your 80s and 90s, which is increasingly likely, the lifetime dollar difference between those two decisions can be measured in the hundreds of thousands. Starting at 62, your benefits would come to about $120,000 over the next 8 years. Starting at 70, you'd get approximately $970 more a month. It would take about 10.4 years to break even, so you'd be around 80 when claiming the maximum monthly benefit begins to pay off in total dollars. But here's the thing that most people miss in that break-even calculation. If you're married, one of the two of you is statistically likely to live into their late 80s or beyond. According to the Social Security Administration, the average life expectancy for a 65-year-old is about 84 for men and 87 for women, and for married couples, there's a strong likelihood that one spouse will live into their 90s. For a couple where one spouse is in their 90s, delaying to 70 doesn't just pay off, it pays off enormously over an extended distribution period. The strategy: if you can bridge the income gap between 65 and 70 using your portfolio and your Roth conversions, you let Social Security keep growing. 8% a year, guaranteed, with inflation adjustments built in. That is a better fixed income return than almost any bond you can buy. This is where the whole system comes together. You've got the behavior solved with index funds, you've got the tax structure solved with catch-up contributions, and the Roth ladder, you've got the fee drag eliminated with expense ratios under 0.1%. You've got the sequence risk buffered with a 2 to 3 year cash position. You've got the healthcare gap budgeted and planned for. And you've got Social Security timed to maximize the check you'll receive for the rest of your life. That's not one thing. That's not two things. It's 5 interlocking pieces that most retirement plans address in isolation, if at all. Getting one right and failing at the others doesn't get you to $1 million. Getting all 5 right does. Let me make this concrete with a real scenario. David is 52 years old. He has $200,000 in a traditional 401k. He earns $90,000 a year as a senior project manager. He is currently paying 1% AUM to an advisor who has him in a mix of actively managed funds with average expense ratios of around 0.8%. His effective total fee load, approximately 1.8% per year. Step 1. David moves to a self-directed brokerage account and puts his $200,000 into a simple 3-fund index portfolio. Total expense ratio, 0.05%. Annual fee savings immediately. Approximately 1.75% of $200,000 or $3,500 in year 1. And that grows as the portfolio grows. Step 2. David maximizes his 401k catch-up contributions. He's 52, so he can contribute $32,500 per year instead of the standard $24,500. He wasn't maximizing before, so this costs him real lifestyle spending, but it's tax deferred, which lowers his taxable income by $8,000 a year, saving him roughly $2,200 in federal taxes at his bracket. Step 3. David starts a Roth conversion ladder. Each year between now and 65, he converts $20,000 from his traditional IRA to a Roth IRA, staying within his current tax bracket. He pays the tax out of current savings, not out of the IRA. After 5 years, he begins to have access to penalty-free, tax-free Roth conversions. By 65, he has built a meaningful, tax-free bucket that significantly reduces his expected tax burden in retirement. Step 4. David builds a healthcare bridge fund. He calculates that if he retires before 65, he'll need approximately $13,000 per year in health insurance premiums. He adds a separate sub-account earmarked for this, so it never gets accidentally included in his investable retirement pool. Step 5. David plans to delay Social Security until 70. He projects his monthly benefit at 67 is approximately $2,300. At 70, it's approximately $2,850. Over a 20-year retirement, that extra $550 a month is $132,000 in additional lifetime income before inflation adjustments. Now run the numbers. $200,000 at 10% for 13 years, David retires at 65, equals $682,000 from the base. Add 13 years of $32,500 in catch-up contributions at 10% annually. That's another $727,000. David's total portfolio at 65 is approximately $1,409,000. That is a conservative scenario using average historical returns and realistic catch-up maxing. David started at 52, not 50, 52. The math nobody shows you is not the compounding math. Any calculator will show you that. The math nobody shows you is the interaction between tax efficiency, fee elimination, and the specific structural tools that only exist at age 50 and above. Those tools are worth hundreds of thousands of dollars in your specific 15-year window. And most people never touch them because their advisor either doesn't know or doesn't get paid to explain them. There's something almost funny about the way the retirement industry works. You pay 1% of your assets per year to someone who hands you a folder with pie charts and tells you to stay the course. Meanwhile, the actual levers catch-up contributions, Roth conversion timing, fee elimination, sequence buffers are freely available in the tax code, in the IRS website, in zero-cost index fund structures. The advisor charges you for access to knowledge you could have for free. The fund manager charges you for returns they are statistically unlikely to deliver. And the target date fund quietly bleeds a fraction of a percent per year, compounding against you for 15 years, while everyone acts like this is normal. It's not malicious, it's just incentives. The system is built to maximize the revenue of intermediaries, not the retirement outcomes of participants. Understanding that is not paranoia, it's how incentive structures work. And once you understand it, the path forward is obvious. Remove as many intermediaries as possible, use the tax code tools directly, and let time do the heavy lifting. This is where Robert's story finally resolves. At the end of our last conversation, Robert was 58, had discovered the fees that cost him $147,000 in compounding, and was starting to understand that his target date fund was doing about as much for him as a very expensive map that forgot to include the most important roads. Robert restructured. He moved to low-cost index funds. He began aggressive catch-up contributions for the remaining 7 years of his working career. He built a 3-year cash buffer for sequence risk. He got a healthcare estimate for the gap years. He modeled Social Security timing with his wife's benefits factored in. Robert is 64 now. He is not on track for $1 million. He is on track for $840,000 because he started the fix at 58 instead of 50. But he is also not working at Costco. He has a plan that survives a bad market year. He has a Roth ladder with 4 years of conversions already matured. And he and his wife have a Social Security bridge strategy that means neither of them claims before 70. The lesson of Robert's story is not, what a shame he waited until 58. The lesson is, he found out at 58 and the fix still worked. You are watching this video right now. Whatever your age is at this moment, that is your 58. 3 practical takeaways. Not generic, specific to this exact scenario. First, run your total fee load today, not your listed expense ratio. Add your fund's expense ratio to any AUM advisory fee you're paying. If the combined number is above 0.5%, you're leaving meaningful compounding on the table over 15 years. The fix is free move to index ETFs with expense ratios below 0.1%. No expertise required. Second, call your HR department this week and find out the exact catch-up contribution limit for your 401k. In 2026, you can contribute an extra $8,000 per year as a catch-up if you're 50 or older, bringing your total possible contribution to $32,500. Calculate what you're currently contributing versus the maximum. The difference is tax-deferred money you're giving back to the IRS unnecessarily. If the maximum is financially out of reach, increase by $2,000 this year. just 2,000. It matters. Third, get a Social Security estimate from your account on ssa.gov. It takes 5 minutes. Then look at the difference between your benefit at 67 and your benefit at 70. Do the lifetime break-even calculation at your current life expectancy. If you and your spouse are in reasonable health, the probability that at least one of you lives past the break-even age is high. That's the whole argument for delaying. You don't need to be certain, you just need to understand the probability. $1 million from $200,000 in 15 years is not a fantasy. It is a plan with 5 moving parts, and 4 of those parts have nothing to do with what the stock market does. They have to do with your fee structure, your tax structure, your cash buffer, and your Social Security timing. Those are decisions, not luck. They are fully within your control starting today. Lazy investing built more fortune than crypto memes. And if you're still paying someone 1% a year to put you in funds that underperform a free index fund, I say that with the warmest, most amused disappointment possible. That's not a financial advisor. That's a very expensive thermostat.